The stock market fell by 10% in 2011 when the debt ceiling negotiations did not go well. For 2023, Wall Street analysts predict a 17% S&P crash in the first quarter alone. Inflation is reducing, but experts say it is not enough. For today's video, we will highlight the debt ceiling, midterm elections, and a possible 150% stock market bubble possible in 2023. Let us begin. In August 2011, the US government was in the final days of its debt ceiling, which called for an immediate negotiation. However, the political climate could have been more favorable. The fear of not raising the debt ceiling caused tremendous damage to the market. This incident lowered the S&P debt ratings of the US government. Due to this, S&P rates the US government AA+ with a positive outlook. This rating, because of the unsuccessful debt ceiling negotiations, is lower than Canada, Germany, Australia, or even Johnson & Johnson and Microsoft, who have AAA ratings. History is repeating itself in the same way. This time, despite the historical lessons, Congress prefers the higher road. Later, we will examine the political string attached to the stock market's bearish outlook. The debt ceiling is how much the federal government can have in outstanding debt. As Simon Moore, a senior investment writer, expresses on Forbes, the political climate that pushed the country into its debt ceiling issues is present again. For instance, during the 2010 midterms under Barack Obama's administration, Republicans won control of the House and Senate. That meant the negotiations were more challenging as Republicans used these issues as leverage. Of course, as the political climate rejected the debt ceiling raising, the stock market fell by 10% flat. Morgan Stanley chief U.S. equity strategist Michael Wilson expects the S&P 500 to reduce by 17% in the first quarter of next year, and U.S. corporate profits to fall 11% throughout 2023, he told Bloomberg. Today, the Republicans have won the House, and Democrats have control of the Senate under Obama's vice president as head of state. The circumstances are familiar and could lead to another political gridlock that could send the market into another bubble. This is because their Republican mates have opposed many actions that Democrats have taken in the last 2 years. That indicates that the friction could become a painful struggle for power and dominance, affecting the market. Notably, many debt ceiling negotiations have happened, but they have yet to weigh down on the market, as experts predict would happen in 2023. This is due to the current economic situation and the possibility of a mild recession. However, things are not all good. Shortly, we will highlight the challenges that need to cool the market entirely. Bank of America instituted a survey among fund managers, and the response shows that they are the least bearish about the US. Still, the country is not entirely off the hook. Perhaps the politicians have learned their lessons about playing politics with debt ceiling raises. As it stands, the US government's debt is hovering around $31.3 trillion. The debt ceiling raised by President Biden in 2021 is $31.4 trillion. This means that only a few federal spending into the beginning of the next year, and the government will be out of legal borrowing jurisdiction. There is no denying that we are very close to the tip of the jar. The Treasury Secretary is buying time, but with general student loan forgiveness alone, the coffers will need more borrowing to sustain the nation. Do you think that this issue will end in a consensus or not? Whatever your thoughts, subscribe and receive updates as the stock markets close for the year soon. Sen. Joe Manchin has made the already slim Democrat lead in the House slimmer because he insists that he will not support the ceiling raising unless there are realistic budgetary cuts. He believes that the House needs to have a bipartisan agreement before he can offer his support. On the other hand, Republicans who raised the ceiling 3 times under former President Trump do not seem to have an appetite for a bipartisan agreement when they take over in January 2023. Meanwhile, consumer prices raised only 7.7%, as they were expected to hit 8% for October. That is the 4th time this year that inflation is slowly declining, as Federal Reserve interest hikes have put markets like housing and stock on a cool-off period. To add, the Producer Price Index, an indicator for inflation among producers, showed that prices rose 0.2% instead of the 0.4% economists predicted. This seems like an improvement until you hear the likes of Greg McBride, Bankrate's chief financial analyst, who thinks that if this constitutes improvement, we've set a very low bar. He insists that despite the statistics, shelter, food, and energy prices are still seeing large and consistent increases. Bankrate is one of the publications that are confident that we will hit a recession in 12 months. However, they confess that the news would hit Europe worse than the US should the geopolitical situation between Russia and Ukraine or Taiwan and China worsen. A global recession is imminent. Since we are not clear yet, you should pick up a few tricks to better shield your assets against the recession. We made a previous video on how to protect your assets during the 2022 recession.